Howdy, y'all. Welcome back to another episode of the Pioneering Perspectives podcast. I'm Michelle Tubbs with our executive director, Laura Butler, and we're your hosts for today's episode. In case y'all didn't know, Pioneers 21 is one of the first and longest running incubators in our border region. Our mission is to inspire and incubate entrepreneurs and businesses through mentorship, training, and connection. In today's episode, we are joined by Alejandro Munoz Mendieta, the managing partner of No Border Ventures. P21 admires the work that you've done. We are glad to feature you on our episode. Hello, Alejandro.
Hello, thank you so much for having me.
Hi.
Such a pleasure.
Glad you could be here, and let's go ahead and jump right into today's episode. So from your perspective as a managing partner of No Border Ventures and with your experience as a founder, what are some steps to take in choosing a VC?
Ooh, we're starting strong, right?
Let's just dig right in. We want
We're
to
gonna
know.
dig right in.
Yeah, we
Yeah.
want to know all of your perspectives.
No, absolutely. I think that's a great question, and actually one that a lot of founders a lot of times can get wrong, right? And I think it's because not all money, is smart money, or not all money is the same, right? So I think, when it comes to founders that are looking to raise money from venture capital, or just in general, when they're looking to raise capital, I think they have to analyze first where they are, where they're positioned, right? Typically, when startups are in their pre-seed phase, when they've just ideated, when they have potentially the idea to launch a minimal viable product and figure out if something works and if there's a market for it. I think founders should not be looking for venture capital at that stage, right? I think at that stage, typically what makes the most sense is for founders to look for angel investments, right? Look for angels that understand the industry, that are passionate about what you're trying to solve, the problem, that you have a relationship with, folks that care about you, that can mentor you and help you, through the initial phases of building a product or a service, and that they can guide you and be mentors, right? I think that's typically what you're looking for when you're barely starting it, right? I think once you've overcome that first hurdle of coming up with that initial test, right, and you've been able to prove out that it works and that people are willing or interested in using your solution, and that they're willing to pay for that, that's when you're probably set up to go to raise funds from venture capitalists. Now, when looking for a venture capitalist, I think first of all, when you're building a startup, it's a long commitment, right? You're probably in it for the next 7 to 10 years, right? Whether it's from maturing it all the way to exit, right? And that's how you should be thinking about what venture capital firms you're looking capital from, right? Because it's a long relationship, right? It's a marriage. It's you have to be looking for someone that you can trust, someone that can confide in you, that can tell you the hard truth, right? Can help you grow, and that they can support you through the good times and the bad times. And especially in startup world, there are a lot of bad times, right? It seems like the good times tend to be short-lived, right? And then you go into the next into the next what would you call it? Yeah, the next problem, or the next stage of growth, right? And that's where you have to focus on. So yeah, you need to be looking for venture for partners that can be great sounding boards, that can guide you, and that that they have your best interest at heart, right? I mean, I've seen it many times, and sadly, I've seen I've seen funds that take advantage of founders, and that they might not give them a fair deal, right? And so you should be looking for folks that can add value, of course, that understand the industry, or that align with your mission and vision, right? And typically that's what you end up having, right? Especially in startups that are successful, they'll have different types of venture capital firms, right? Typically they'll have their lead investor, which typically aligns very well on in the type of industry, that understands folks that will be on the board, right? So typically lead investors will be on the board of a startup. And then you have other types of funds, right? Maybe they come in with smaller checks, but they, their values aligned. They might be able to guide you in different ways. They might support you in hiring. They might do other things that add value to your venture, and that you can trust them. But they're not necessarily folks that are going to have a formal seat at the table, but folks that you can, reach out to and they can support you.
Very interesting. And when, let's say they're ready for, that venture capital, and they've seen the right target audience and they've done all the research and they've done their due diligence, how can one go into a deal with confidence, ready to talk to that venture capitalist?
Yes, I think, I think I've mentioned this before in some other sessions, but typically what you're doing as a founder is that your whole job is to de-risk, right? That you're trying to de-risk the business or the venture, the idea at every step of the way, right? So the more you're able to de-risk the opportunity and give folks more certainty that it will be successful, I think that gives you a lot of confidence, right? It gives you an upper hand. So let's say, for example, if you have a product or a service that you have a lot of demand for, or that you've already begun to generate some revenue, you have some traction, and there's a clear product market fit, I think that gives you a ton of confidence, right? When it's something that's maybe unproven or you haven't onboarded that first customer, that can be difficult, right? So the more you can de-risk things, the better, right? And that gives you a ton more confidence. And I've mentioned, a concept before of, the old adage of time is money. I talk about money is time, right? And at every stage that you're raising capital, what you're doing is you're buying time, to make more experiments and de-risk and achieve certain milestones. So when you go to a venture capitalist, you have to come in, especially at the early stages, with understanding what the risks are, what your plan is to reduce those over time, and what are the KPIs or the milestones that you want to achieve with the round of financing, right? So at the same time, you have to also show what you've done so far. I mean, you might not have as much capital, but maybe you've achieved a significant progress without that capital. And that already gives folks a lot of confidence in that you've done a lot of work, you've bootstrapped, right? Many times, maybe you've put in some of your own capital if it's been possible, or that folks have already believed in you, right? Could be angels, could be family and friends, but that you've already done some work on the back of that helps de-risk things in the mind of the venture capitalist. On top of that, I would say that maybe you have an idea and you haven't launched it yet, but you have a lot of experience in the industry. I think that's also that track record helps, quite a bit. So if someone has experience in solving a problem or has been working in a specific industry, that gives you a lot, right? And that tells venture capitalists, hey, this person might not have the full solution yet, but there's someone that can get to that solution, right? And they already have experience. They have a lot of the resources. They have the network to be able to get there, right? And the potential customers. I mean, if this person is leaving an industry or a very established job to go launch something, and even in their previous career, they've grown, right? They've demonstrated success. There's an opportunity that they'll do it again.
And I love that you bring up the phrase that money is time, because everywhere you hear people say that time is money. And I've actually used that phrase myself where you're like, oh, time is money. And can you talk a little bit more about that phrase, that money is time?
Yeah, of course. And I'm not going to take credit for it. I learned it from a professor of mine at business school, and I love it. Right. And because it's true. I mean, when you're launching a new business, when it's a startup or a small business, and you're trying to get adepts or folks to believe in you and get those initial resources, you're getting those resources. I mean, what you're trying to do is they're going to give you those resources, but you have to give them an action plan, right? You need to tell them what you're going to do with those resources, what you're going to achieve with them, and then what the next steps are, right? So if you show progressive plan that, hey, I'm going to test this out, and if things go well, I need to achieve this, ABC, and if things do not go well, I'm going to try this, right? And I think similar to a relationship. I mean, and I think that's where a lot of things, where a lot of successes are built, or where things fall apart is in communication, right? And so if you're upfront about what can go well and what can go wrong, and you have a plan as to how you want to address things and give folks an understanding that how you're going to use the resources, it helps, right? Because it's very different. There's another one that goes hand in hand with this, with money as time, but failing forward, and it's very different to fail in an experiment or fail in an initial idea, having given people transparency and clarity as to what you're trying to do, than failing and disappearing, or failing and not having given context as to what happened, right? Because if you've been very upfront and transparent from the beginning, it's much easier for folks to continue to support you and believe in you, right? So, example A, I go out and raise, I don't know, $200,000 from an angel investor, and I keep them updated. I have, my regular monthly communications. I tell folks what went well, what didn't go well, what are the expectations, or what I want to reach or achieve over the next quarter. And things don't go well, it's very different, right? And that investor might say, well, things didn't work out, but they tried. They showed me their way of thinking, how they began to address things. And when things start to deteriorate, how did they do it, right? Because it talks to character, right? It's very different to do that than, hey, appreciate the $200,000 investment, but then I don't communicate, for 6 months, 8 months, and all of a sudden the investor reaches out to ask, hey, how are things going? And the founder's like, oh, well, we're closing next month. It's a very different conversation. And a lot of times, if you keep people informed, they might be able to support you in other ways, whether it's more capital, or introduce you to people, because at the end of the day, they want to, they want to take care of their investment, right?
Right.
So they'll do whatever is in their hands, and it's in their best interest to support you. So that could be the beginning of that conversation, but that's how I think of it, right? So whenever you raise money, you have to go in with a clarity of, you need that money because you want to achieve ABC, and this is how I'm going to do it. This is the plan, and things don't go well, this is how I plan to address it.
And that transparency and that consistency is so important for entrepreneurs to maintain with those VCs. And another question that I had was, when a VC is going into that conversation, what is the ideal percentage that a founder should keep in their mind that they should own?
Sure. I mean, there's a, back of the napkin, dilution that founders should expect, at each stage. And that's, roughly between 15, 20% that they should be willing to give up at every stage. But I tend to tell founders to not think of it that way, right? I mean, they should be thinking of, maybe that percentage is up, or goes up or down, a little bit. Of course, you should never give up, 50% of your company at the very beginning. If not, do you as a founder, do you actually believe in what you're doing? And do you think the investor has your best interest at heart? Probably not, right? Because at the end of the day, it's a delicate balance between, yes, you want to have investment to grow. You also need, it's a delicate balance between that, between believing in your idea and having the ability to make decisions to make that happen, right? How do you strike those, that balance and motivation, right? I mean, no VC fund is going to come out the gate and tell you, hey, I want 50% of this, because then there's no incentive for the founder to keep growing or want to build, and expand and scale the business. So you should be thinking about it more so in terms of, can this investment help me grow the vision that I have? Right? It's not necessarily about how much I'm giving up, but how is this investment going to help catalyze the size of what I want to build? I'd rather own a smaller piece of a bigger pie than own half of a very small pie, So when you go into that conversation, I would rather, and that's, I think, what I've mentioned in the past, and maybe some of the sessions that we've had here, is you have to think about what investors you're bringing on board, right? Do I value this investor's background? Do I value their experience, what they can bring to the table? And are they giving me a fair deal, right? I mean, yes, right now it is an investor's market, and they're more, call it, milestones or bells and whistles that fall on the side of the investor. But at the end, is it a fair deal that will help me build this company over time? I mean, ideally, if you're thinking, I mean, at first I own 100% of the company. First round of investment, I'm down to 80. Second round of investment, I'm down to 64. Third round of investment, I'm down to 48, 50%. That's okay, right? Because now you've grown the company significantly by that stage. And I'm using very rough estimates, and depending on the industry and all that, but by that stage, your company's probably worth a couple $100 million, right? And that's already, it's given you that initial ownership has given you the ability to say, hey, I want to continue to grow this, and I can make the right decisions, right? Because it's also, that's the other thing. And when I talk about that delicate balance between ownership and also having someone that trusts you, the investor's not investing in the company because they believe that is going to be the solution 10 years from now, right? It's very likely that a founder will pivot throughout the lifetime of the company. So the investor is really investing in the problem that you're trying to solve, but in the founder, right? Also the founder, I mean, and they're investing in the judgment of that founder, and if it's someone that can scale that specific idea or that vision, right? And so at the end of the day, the founder is the expert. The founder is the expert. The founder knows the needs of the company and understands the customer much better than an investor will, right? So yeah, and then that's what I mean. You need to find an investor that really believes in you, believes in the idea, and that is there to support you through the good and the bad.
Alejandro, I have a few questions, more just pivoting a little bit to No Border Ventures and some information that can be found on noborderventures.com. So for No Border Ventures, 3 of the reasons that you decided to launch NBV was to empower the Southwest and mountain entrepreneurship, promote cross-border innovation, and to diversify VC landscape. Now, when you first came to El Paso, decided to come back as an expat, you mentioned that 40% of unicorns are built away from the coast, 50% of unicorns are born in the Southwest, and 11% of unicorns are founded by graduates of the Southwest. And I believe that more and more, especially attending VC events, pitch events outside of El Paso, you almost always meet people from our region that are building things outside. of El Paso. Tell me a little bit more about your strategy for MBV and what your goals are.
Sure, and let me and thanks for bringing that up, because I think it talks to why I'm back, right? For those that don't know me, I'm originally from Juarez and El Paso. I'm originally from the region, and I just moved back here about a year ago as part of building.
And we've been so serious. I want to stretch out and say congratulations on your recent marriage.
Thank you so much. I have the ring here to prove it. But
Congrats!
Thank you so much and yeah, a lot of excitement around that. And funny enough, just quick detour there, but as part of me coming, I came back to El Paso about 3 years ago as part of this expat program. It was about reconnecting with the region, understanding all the great things that are happening.
Was it with Progress 321?
Yes.
Our friends at Progress 321?
Yes, that's great. Right. And so I was part of one of those classes, expat classes, and that got my juices flowing, right? I mean, I enjoyed my work at the startup, but it also started get me thinking about the potential, right? And got me to start digging a little bit deeper. In addition to that, I was able to reconnect who's now my wife, right? I mean, she and we went to college together about 15 years ago at Utah, and we reconnected as part of that program. And so now I'm back here as an investor, married with one of those progressors as well.
You all met at the.
So she's part of she's on the board of Progress 321, and so I reconnected with her. As part of that as well.
That's great. That's a great story.
So the program's doing its thing, right? And going back and I think it talks to some of those.
That is so cool.
I know. And it talks to some of those figures that you were mentioning at the beginning, and I'll just add a little bit of context and clarity to that. So when we started, I mean, first of all, when you're building a fund and trying to build a thesis, it's both about where can you find alpha? I mean, where can you find differentiation? Where can you win? Right? It's not the same. Well, I can source and find a lot of deals, but also how can I win them? Right? Do I have the capacity to do that? And do I have the capacity to work in those regions? Right? And so when we start to look at the Southwest region, which for us encompasses Texas, New Mexico, Arizona, Nevada, Colorado, Utah, and Oklahoma, we identified a couple of things, right? And first, this analysis we did both bottoms up and top down. And so starting at the top, as you mentioned, about 80% of capital in VC is invested along the coasts, right? Or in the big metros, right?
Yeah. East Coast or West Coast.
Yep. And so what happens? I mean, yes, when you think about Silicon Valley, when you think about New York, when you think about Boston, very mature, very resilient, very, very big entrepreneurial ecosystems. You have a ton of opportunities, a ton of companies to source from, right? And so when someone's building a fund that says, "Oh, I'm going to focus on companies from Silicon Valley or New York or in the medical field, from Boston," people get it right away, right? There are a ton of companies you can source from, but at the same time, that also creates certain issues, right? Especially we lived that, about 3 years ago when valuations were sky high and there was so much capital in the system. Valuations were through the roof, right? And so a lot of times you end up investing in these, in these companies that get overhyped, and maybe the investment doesn't pan out. And so what the numbers say is that yes, 80% of the capital gets invested along the coast, but it tends to be inefficient capital because of those dynamics. And you only end up producing about 60% of the unicorns. Unicorns, for if you're familiar with the firm, are those companies that are worth at least $1 billion, right? That can mean many things, right? But yes, that's a typical term. And what happens with the other 40%? Well, we identified that they come from everywhere else, right? And I think especially in these, in these uncertain times, and of course, venture capital is uncertain, right? It's about trying to de-risk as much as possible. But what are you looking for in companies nowadays? We're looking for And I think you and I have heard this in other panels and other conversations, but those companies that are more resilient, that are bootstrapped, they can do a lot more with a lot less, that some folks call them camels, right? So those folks that with a little bit of investment, they can weather the storm and they can go through long periods building, maybe in silence, but then eventually they will be successful, right? And become those unicorns. And so with that landscape in mind, we started to think about, okay, what's interesting about us? Both my co-founder and I, we're both from El Paso. We're both from the region. And one thing that's connected with us throughout our life is the brain drain that everyone hears about, right? So a lot of folks leave the region and they go out and do great things and they don't come back, right? And thankfully, we're starting to see a bit of a reversal of that throughout the country. And part of it was COVID, part of it has been better opportunities, remote work, etc. And so when we started to dig into the numbers, out of those unicorns that are built, out of those unicorns that are built in the United States, 11% of those unicorns have been built by folks that we educated in universities in our region, and in the Southwest Mountain region. So these are folks that maybe some of them, they might have stayed, but the majority of them left. They left they left Silicon Valley. They went to New York. Why? A lot of times because they couldn't retain talent, find talent, or they couldn't find the capital to support them, right? There were very few VCs in the region, or few mature entrepreneurial ecosystems. And so they left, right? Thankfully, we're seeing a reversal of that, right? Over the last decade, about 50 unicorns have been built in the Southwest Mountain region. And that's because you're getting more mature ecosystems. Folks are coming back. Fortune 500 companies are moving their headquarters back to the region. I mean, just recently Tesla, right? Mm-hmm. Tesla, Elon Musk. But then there are many more companies that their CEOs are and their talent, they're moving to the region, maybe because prices are lower, where there's better quality of life. Different things are bringing that talent back to our region, giving possibilities to build and create new ventures. And I think that's great. So I think, all those opportunities are the foundation or the basis for No Border Ventures, right? What we're trying to do is, and thinking about what differentiates us and what can we do, or where do we think that we can help. Those three things. I mean, first of all, when it comes to diversifying the venture capital landscape, I mean, nowadays, less than 2% of the funds that are managed in the venture capital world are managed by Hispanic venture capitalists. Less than 2%. That's incredible. I mean, we represent a larger portion of the population than that, and we're the fastest growing economy, right? Hispanics, I mean, we're $3 trillion, capacity in industry and growth, and what we mean for the U.S. economy. We're severely underrepresented when it comes to venture capital, right? And so when you have fewer venture capital, I mean, you tend to invest in what you know, right? If you have fewer venture capital as well, then at the same time you have fewer Hispanic founders being invested in, right? So that's number one, right? Number two, supporting these, what a lot of people would call flyover states, right? I mean, yes, you have the big ecosystems on the coast, but then all these other ecosystems that are growing and that are, showing strength and opportunity, that's where we want to play in, right? We want to do the hard work, identify, support founders, and invest in the ones that we think are going to be, we call ourselves good troublemakers, both Annie and I, in the sense that, we've, similar to the talent, and people can relate to this, to the talent from this region, we're folks that we've had to make our own way. We don't necessarily come from, we don't come from wealth. We've built everything that we've achieved so far, and we've had to be creative. in many ways. And if there wasn't a door there for us, well, we've created one, right? And that's why we're building No Border Ventures, right? If the industry wasn't going to create a door for us, well, let's go out there and make it, right? And so we're entrepreneurs in a sense, right? We're also entrepreneurs. We're in this together, so we understand and we can empathize with founders from the region. And so with that, lastly on the cross-border part, if we look at some of the trends or some of the industry opportunities that will define, the next, 100 years, they have to do with things that we experience here along the border or along the border states, right? We look at things related to commerce. So nearshoring, nowadays nearshoring, it's becoming a reality with Mexico becoming the US's largest trade partner. So that definitely causes, we have more population, more industrial needs. But with that relationship strengthening, we need better logistics solutions. We need to improve supply chains. And at the same time, if you do that and you grow industry, you're going to need more power, right? You need more and better energy solutions. So we know that, that fossil fuel is an important component, but it's not the only component, right? We need to strengthen the ways in which we're going to power industry. So we look at alternative energies, renewables, nuclear, etc. All those things matter, right? And that's going to be a trend for the next 100 years. And then when we think about how are you going to bring underserved populations, how are you going to bring them up? And a lot of it has to do with financial literacy and also access, right? Mm-hmm. And about 30% of the population in the Southwest Mountain region is financially underserved, right? So there's definitely a lot of opportunity for fintech startups to serve these populations and create opportunities to bring more equity in that sense. So yeah, we think, of course, there are other trends related to AI, but those are just going to empower, software solutions that we look at. But when we think about supply chain logistics, we think about energy, we think about financial technology. Of course, there are others related to healthcare, but I'm not the best person to comment on that industry. But at least the ones that I know, and I think those relate to the border region, right? And the only way you're going to make a lot of these, the companies that will be successful in these industries are the ones that take advantage of both sides of both sides of the border, right? That can serve both types of clients. And that's where we want to play and where we think that we're differentiated and where we think that we understand, we can empathize with founders.
Thank you. I think this is a call to action to really join the movement and to empower and uplift Latino entrepreneurs. And as a Latino investor, if you're out there, you have the power to drive innovation, create generational wealth, and fuel businesses that really reflect on our diverse culture. Really investing in the future of our community today, and together we can build a stronger, more prosperous Latino business ecosystem. And your investment is not really about capital, but really about commitment to shared success. And this really emphasizes both a financial opportunity, community impact, and really encouragement of engagement from Latino investments and entrepreneurs. I think that was really inspiring for you to share. Thank you.
No, thank you. Thank you. And I think maybe the only thing I would add there is, I think especially in this region, there's so much capital in this region that there's thankfully, there's a lot of wealth that I think we can use to accelerate, right? Growth in especially these industries that we understand so well, right? How can we bring them up to speed in the 21st century and create and have more innovation, right? And so, I would invite folks to become angel investors. I mean, if they're founders that you believe in, folks that you understand their industry, that they have an interesting solution, support them, And maybe at first it's with mentorship, but if you're able to provide that initial capital to these startups, they will greatly appreciate it. And there are different ways of doing that, right? And there's a right way and there's a wrong way. I mean, you don't want to find yourself as an angel investor going out and asking for 50% of the company, right? The economics are very different in the venture space. And so what I would, call to action there is, if you're interested, if you want to support growth in these industries, if you want to support entrepreneurs, also get close to some, to Pioneers 21 and to organizations that can support you in that process. You're not there alone. You don't have to make that decision in a vacuum. And it's about how can you get educated, and there are resources to help educate you in terms of how to think about an investment, how to analyze how much to invest, how much to ask for. And I think, if we're able to build a vibrant angel community, we're going to see a very different entrepreneurial ecosystem in the region over the next 5 to 10 years.
Thank you for sharing that. Michelle, any final thoughts from you?
Thank you for being on this episode. I think you've brought a lot of knowledge to at least me. Definitely learned a lot in this episode, and I'm sure our listeners will get a lot from this as well. So thank you.
I want to share that if you want to hear more about venture capital and also hear more about another fund in our region, on October the 3rd, we will be here at Pioneers 21, and we will be hosting the Texas Venture Fest, where Emma Walschlager-Schwartz will be talking on a panel with our guests today, Alejandro Munoz Mendieta. They will both be sharing their more insights on venture capital, but we will be hosting the Texas Venture Fest at 5:30 p.m. And that will be going on for about 45 minutes to an hour panel. And then it'll be a celebration where you will get to network the rest of the time. But we will have a great panel discussion with these two fund leaders. And we hope to see you there.
Thank you for joining us.
Thank you so much. It's always a pleasure, and really appreciate all the work that you all do at Pioneers 21 in building this entrepreneurial community. And you've been amazing partners, and I look forward to working with you for many years to come.
Thank you. I believe that you also have a set of workshops that are starting
today.
Today is the first workshop, and that will go on for 6 weeks.
Yes, that's right. So I'm being brought on board by UTEP to give out this workshop on venture capital and startups, and it's part of it is to share, in a more expanded way, the condensed conversation that we had today for startups and founders to think about, the KPIs that they should be looking at, how to fundraise, how to think about valuation, to get in the mindset also of a venture capitalist. Like, what do they care about? How do they view things? And hopefully, all these tools will help will help folks to either go in with a lot more confidence when they go in and raise capital, or if they ever want to become investors, how to do it. How to do it in a responsible and meaningful way.
Where can we find more information on that?
Sure thing. This is being hosted by the Mike Loya Center.
Okay.
At UTEP, and so through their website,
okay.
All the details should be there. But yeah, that workshop starts today and it goes through early November.
Great. So y'all can find it through the Mike Loya Center and Mike Loya Center for Innovation, and just search for those workshops. But we should be able to post them and send them out so everybody can see. Thank you.
No, thank you so much. And the idea is hopefully to do that recurrently, every semester, and hopefully create more opportunities for folks to continue to learn about the space.
Thank you.
Thank you so much.
Thank you.
Appreciate the time.